Hello everyone, and welcome back to Collin Investing, your go-to channel for insightful analysis on finance and investment. I am Collin, and today we're diving deep into a market landscape filled with mixed signals, looming risks, and some critical updates on key stocks and ETFs. We have a lot to cover, so let's jump right in. Hello everyone, and welcome back to Collin Investing, your go-to channel for insightful analysis on finance and investment. I am Collin, and today, we're diving deep into a market landscape filled with mixed signals, looming risks, and some critical updates on key stocks and ETFs. We have a lot to cover, so let's jump right in. So, what a roller coaster we saw at the end of last week. The major indices staged a late rally on Friday, climbing over 1%. It definitely felt like a sigh of relief, partially reversing the losses we saw on Thursday. But, and this is a big but, that rapid surge actually caused the S&P 500 to miss a crucial opportunity to repair its monthly RSI. We'll unpack that a bit more in a moment, and you will see why is important. Related to the S&P, and as many of you requested, I've also updated the QQQ long-term support levels. We're going to check them in detail now. Probably the biggest shocker, and something that really caught my attention, comes from the GDP Now model. This model is now forecasting a Q1 2025 recession, and get this at negative 1.5%. That's a massive downward revision from the previous positive 2.3% projection. Just consider that for a second. We're talking about a dramatic shift in economic outlook, and that lead to something interesting. Naturally, this has fueled market expectations. We're now seeing increased anticipation for 3 interest rate cuts, up from the previous expectation of just 2. This is a direct response to that recessionary forecast, and it shows how quickly the narrative can change in this market. Building on that point about shifting economic outlooks, let's turn our attention to a significant risk that's been brewing: stagflation. The February data paints a concerning picture. We're seeing inflation ticking upwards, while economic growth is simultaneously on a decline. Now take a look at this chart. You'll see a widening divergence between inflation, represented by the green line, and economic data shown by the red line. That separation, that growing gap, is what starts to raise red flags. This brings us to a critical question. Are we heading towards stagflation? For those less familiar with it, stagflation is essentially a toxic combination of high inflation, slow economic growth, and usually rising unemployment. It's a real headache for policymakers and, frankly, a major risk for the stock market and the Federal Reserve's policy decisions. Imagine that you invest in the stock market. However, the economy stagnates and the inflation is rising. This will probably be reflected in the asset's price. I've been analyzing markets for years, and periods of stagflation are notoriously difficult to navigate. It's like trying to sail a ship through a hurricane while the rudder is broken. Now, I want to be clear. It's still too early to definitively declare that we're in full-blown stagflation, but the warning signs are certainly there, and we need to monitor this very closely. We will be tracking these trends, and I'll keep you updated on any significant developments as we move forward. And that's where the macro news comes in, adding another layer of complexity to the mix. We've got 2 significant events on the horizon that could introduce further market volatility. First, mark your calendars for the 4th of March. That's the deadline for the U.S. to decide on tariffs for Canada and Mexico. Whether those tariffs are implemented or not will have a ripple effect, potentially impacting trade relations, and consequently, market sentiment. We have seen this situation before, and we know the consequences. I remember how some policies like this affected certain sectors. We'll be keeping a close eye on that. But that's not the whole story. Beyond North America, geotensions are also simmering. There have been reports of increased tensions in Ukraine following the failure of mineral agreement talks. This adds an element of uncertainty to the global landscape, and markets hate uncertainty. It's something to be aware of, as any escalation could trigger broader market reactions. So, between trade deadlines and international tensions, we're definitely navigating some choppy waters. With that in mind, let's examine the SPY's technical picture in more detail, and this is where that missed RSI repair opportunity really comes into focus. Remember that dramatic last-minute rally I mentioned earlier? Well, it had an unintended consequence. It prevented a crucial crossover on the monthly RSI, a technical indicator that helps us gauge momentum. Essentially, the rally was too strong, too fast. This lack of a crossover signifies a missed opportunity for the market to reset, so to speak. It's like a pressure valve that didn't quite release. This leads us to an interesting paradox. Although the rally looks good, we have an issue in the long term. Now, you might be wondering, what does this mean for the bigger picture? Well, it reinforces the long-term top divergence that we've been tracking. This divergence, and this is key, implies a future monthly decline, I am not talking about a minor dip either. This is a high probability event, as in virtually 100% certainty based on historical patterns. The frustrating part, of course, is that we can't pinpoint the exact timing. It's like knowing a storm is coming, but not being able to say precisely when it will hit. So, what's the take-home for investors? In my view, it strongly suggests that the market hasn't finished its decline. We should brace ourselves, and I mean, really, brace ourselves for further volatility ahead. The long-term support for SPY lies below 573, so we need to be prepared and consider that level. Now, let's shift our focus to the QQQ. Remember that SPY long-term support below 573, it's crucial, and the QQQ has its own key levels to watch. I've identified several long-term support levels for the QQQ that are worth highlighting for you. First, we have strong support at 488. This is a level that has historically seen significant buying interest. Building on this, consider a zone between 472 and 488. I'd classify this entire range as a good long-term entry zone. If you were looking to build a position in the QQQ over time, this area presents a compelling opportunity. However, there is a counterpoint to consider. Below that, we have another key support area between 436 and 448. So, what does this all mean for potential corrections? Well, a 10% correction in the QQQ which, and I want to emphasize this, is not uncommon historically, would bring us right down to that 448 level. It's a reminder that even in strong markets, pullbacks happen, and they can be swift. So keep these QQQ support levels in mind as you manage your portfolio and assess your risk tolerance. We always must have in mind the key levels. Let's dive into some specific stock updates, and we'll start with Tesla. I know many of you are closely following this one, and, well, February was brutal. The stock was down roughly 28%, making it Tesla's second worst month in its history. To put that in perspective, the absolute worst was back in December 2022, when it plummeted 37%. So, not a record, but definitely a painful drop. I have updated the key price levels, so let's check them. I made some adjustments based on recent price action. We've got support around 273, and interestingly, that level was actually tested today. On the upside, we're looking at near-term resistance in the 282 to 320 range. Above that, here is a stronger resistance zone between 324 and 361. Now here's something to consider. If we see a substantial rebound, and I mean, really strong one, the maximum potential, at least in the short term, would be that 324 to 361 area. Given the overall market conditions we discussed and the specific challenges Tesla is facing, that level would likely be a major hurdle. And that's an important takeaway from Tesla. Let's move on to Nvidia, another stock I know many of you are watching closely. So far, it's largely been following the script we laid out. We talked about it closing within that $125 range. And well, that's precisely what happened. Now, in the short term, the direction is frankly a bit murky. It's like trying to read tea leaves. Here's no clear signal, however, and this is critical, that $112 level remains the key long-term pivot point. We've discussed this before and it bears repeating, it's that significant. Now, for those of you with a more aggressive investment style, here is something to chew on. The current price is actually sitting within the lower end of its forward P valuation range, somewhere between 30 and 40 times earnings. This could represent a potential entry point, and only if you believe Nvidia can maintain that premium valuation. But, and this is a major caveat, there are some technical warning signs. If the price breaks below $118, it weakens the chart. It's like a crack appearing in a foundation. And if it goes further, if it breaks decisively below $112, that, in my view, invalidates the thesis for a sustained high P ratio. It would signal a significant shift in market sentiment. So, what am I doing personally? I'll share my own holding plan with you, just to be transparent. I currently have a 12% position in Nvidia with a cost basis of 91.18. Here's my plan, and it's based on those key levels we just discussed. If the stock closes below $118, I'll proactively reduce my position by 2%. It's a precautionary move, a way to manage risk. Now, if it drops further and closes below $112, I'll take a more significant step, reducing by another 4%, bringing the total reduction to 6%. I am essentially cutting my position in half at that point. This isn't a panic sell, it's a calculated decision based on the technical breakdown, and that's where the potential buyback comes in. If we see a compression in the P/E ratio down to the 20 to 30 times range, I'd consider buying back shares in the 80 to 97 range. It's all about adapting to changing conditions and managing risk while still positioning for potential upside. It's important to note that my strategy is based on my personal risk tolerance, and it might not be suitable for all investors. It's always recommended to make investment decisions considering your risk tolerance. And that's where Nvidia's situation comes in, because any weakness in Nvidia, given its heavyweight status, could significantly impact the broader semiconductor sector, particularly the ETFs. We're going to take a look at two key ones, SOXX and SMH. Let's start with SOXX. The technical picture here is, well, it's not looking great. We've seen strong resistance forming, and it's now sitting at 211. That's the lower boundary of the resistance zone, which tells you something about the selling pressure. For SOXX to regain any real bullish momentum, it needs a decisive breakout above 235. That's a long way off right now. Now, on the flip side, the support levels are frankly weaker than the resistance. We're looking at a support zone between 197 and 208. But here is the crucial point: if a SOXX breaks below 197, that confirms a downtrend. It's a clear signal that the bears are in control. Let's switch gears to Collin investing, and unfortunately, it's a similar story. This ETF is also exhibiting a low center of gravity, meaning it's vulnerable to further downside. We've got support in the 215 to 229 range, but just like SOXX, a breakdown below that lower boundary confirms a downtrend. The technical indicators, at least for me, show a concerning picture. On the resistance side, we see a medium level between 232 and 235, and a stronger one further up between 239 and 257. So both of these ETFs are in a precarious position and largely at the mercy of Nvidia's performance. Any significant move in Nvidia will likely dictate the direction of these ETFs in the near term. Before wrapping up our deep dive into specific stocks and ETFs, I want to briefly touch on a few other names making headlines. These are quick updates, but they're worth noting as they provide a broader view of what is moving the market. First up is Apple. We've seen their revenue growth start to tick upwards, which is encouraging. And get this, iPhone sales actually hit an all-time record. This indicates that despite all the talk about a slowing consumer, here is still strong demand for Apple's flagship product. Now, let's switch gears to a smaller, but potentially disruptive player in the AI space, Tempest AI. They just announced the national launch of an FDA-approved diagnostic device. That's a big deal, and it's a good moment for the company. Plus, they've secured agreements with some major healthcare players like Blue Cross Blue Shield of Illinois and California and Avalon. These partnerships could be key to their future growth. This brings us to a critical question. Will the company keep growing? We'll be keeping an eye on them. Moving on, we have Nebius Group, another AI-focused company. They recently outlined their strategic focus areas for 2025, and, notably, they're working with Uber on autonomous technology. It shows the continuous growing interest in AI technologies. And finally, let's talk about Terlood. They're quietly gaining market share in some crucial categories, and their automotive and Internet of Things, or IoT, revenue saw significant growth last quarter. It's a testament to their diversification strategy and their ability to capitalize on emerging trends. So, even while we focus on the big names, it's important to keep an eye on these other players, as they can often provide insights into broader market trends and potential investment opportunities. So, we've touched on Apple, Tempest AI, Nebius Group, and Dwillows, each with its own unique story. But now, I want to shift gears to something that's weighing heavily on the minds of many investors, and it comes straight from one of the most respected voices in finance, Warren Buffett. This brings us to a critical question about the general market situation. His 2025 shareholder letter contained some unusually bearish warnings about the U.S. economy, and that's not something to take lightly, you know. Buffett is typically known for his optimistic long-term view, his unwavering belief in American resilience. I remember one of his quotes, "Do not bet against America," but this time the tone was different, markedly so. We're seeing frequent changes in Berkshire Hathaway's portfolio, which is in itself a departure from his usual buy and hold approach. He's clearly concerned, and his concerns center around two main issues: the ballooning U.S. debt and the long-term status of the dollar. He's not just worried about the size of the debt, it's the potential consequences, the possibility of runaway inflation, that really has him on edge. And perhaps most tellingly, Berkshire is actively increasing its investment in Japanese trading companies. Think of it this way: he's diversifying away from the US dollar, seeking refuge in other markets. That's a powerful statement, and one that should make us all pause and consider the implications. Now you might be thinking, what should I make of this? What is the real meaning of this movement? I think it's a wake-up call. It's a reminder that even the most seasoned investors are navigating uncharted waters, and that prudence and diversification are more critical than ever. And we are going to discuss the conclusion in our next part. So we've covered a lot of ground today, from market volatility and stagflation worries to specific stock updates and, finally, Buffett's rather concerning outlook. It's clear that we're in a complex and frankly uncertain environment. It's a time for caution, for careful analysis, and above all, for staying informed. And that's precisely what we strive to provide here at Collin Investing. I hope this video has given you some valuable insights and perspectives to help you navigate these turbulent markets. If you found this content helpful, please show your support. Like this video, it helps us reach more people who can benefit from this information. Subscribe for more finance and investment content. We're constantly analyzing the markets, and we'll keep you updated on the latest developments. Leave a comment with your thoughts and questions. I love hearing from you, and your feedback helps shape future content. And finally, share this video with others who are interested in investing. Let's build a community of informed investors together. Thanks for joining me today, and I'll see you in the next video.